Live with the mortgage calculator. Today we're going to go through some live mortgage rates and then do a deep dive into portfolio loans. We'll wait just a couple minutes here to get started, give everybody a chance to hop on and give us a chance to go live on all the different platforms because we are streaming this live on YouTube, Facebook, and LinkedIn. So we appreciate everybody tuning in from all the different platforms. Give us a moment here while we get started. We did put the chat up on the screen there, so feel free to drop a comment. I see Adrian, Key, Adam. Thank you for the comments nice and early. Appreciate that. As everybody tunes in, feel free to drop a comment there. And as we go through the presentation, feel free to ask questions as well on the topic for today, which is portfolio loans. Let's see. Thank you, Jason, for the comment from LinkedIn. Appreciate it. Appreciate everybody tuning in on all the different platforms. It looks like we are up and running, so we are good to go. We'll take the chat off the screen, but please keep dropping comments there in the chat and any questions that you have as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of The Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. What we do on this show every morning is go through live mortgage rates, and then we do a deep dive into a different topic. Now, today's topic is going to be portfolio loans. Now, as a lender that specializes in non-QM loans and investor loans, this is something we're very familiar with. Now, there is a lot of misconceptions about portfolio loans, and there are a lot of people that don't know the advantages and disadvantages, the pros and cons of portfolio loans. So this will be a good deep dive topic here for today. So our sales manager, Jose Gonzalez, with 28 years of experience as both a loan officer and a realtor, is going to do a deep dive into portfolio loans today. But before we do that, we'll do what we do every morning, which is pull up our pricing tool and go through the live mortgage rates for a few different programs. So, Nick, if you're ready, let's go ahead and pull up the pricing and see what the market is looking like this morning.
All right, let me switch my screen and we will check it out. So this is our pricing tool for our team of mortgage pros. This will show us the general rate and APR for today. It is September 15th, just after 11 a.m. Eastern, so all the general programs have live rates issued. If you'd like a full breakdown of all the fees that go into the APR, a full loan estimate, please get with our team members. We have over 400 licensed loan officers in 24 states for primary second homes, and we can do our business purpose loans like the portfolio loan we're going to be talking about today in 44 states. So for all our demos today, we'll set up a scenario that we can compare across the program to compare the APR. We will set a loan amount of $400,000. We'll set an LTV of 80% loan, 20% down payment. We'll set a desired price of $99, meaning we're going to ask the computer to find the best rate at one discount point in cost. And we'll compare our options as we do every day. We'll check out conforming conventional, and then we'll pull up the FHA programs. And then we'll go into our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs with alternate income. We also have VA and USDA. VA is only for eligible vets and active service members. If you are one of those eligible persons, please let us know. We can quote it, no problem. And USDA is only for eligible properties. If you do happen to be shopping in one of those USDA areas, let us know. We can quote that up, no problem. So we'll start with conforming conventional. We'll do a purchase, 30-year fixed loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO of 760 and an estimated debt-to-income ratio of 40%. So with these basic settings, let's check the rates today. And looks good, about the same as it was yesterday, which was lower than the last couple of weeks. So that's great, 7.125 rate, 0.875 discount points in cost, puts a final APR 7.287. So a good option for our customers that qualify for conventional. But if our customer doesn't qualify for any reason, typically the next option we want to look at, we pull up the exact same scenario so we can compare apples to apples, is an FHA program, which does allow a little more leniency on credit issues as well as a higher debt to income ratio. But we'll keep everything exactly the same so we can compare APR across the programs. So with the same exact quote here, FHA 6.5 rate, 0.875 discount points and costs, puts the final APR at 7.088. So just a touch cheaper than conventional if our customer qualifies for both. So definitely recommend our customers don't overlook FHA with the reduced mortgage insurance that came into place recently. That's a great thing. And our customers that need to use it, great option here for our FHA rates. Now, where we love to specialize is if our customer doesn't qualify for any reason for other programs. Many other banks or lenders may have to deny them, but that's where we love to present our expanded guidelines non-QM solutions. So when we select expanded guidelines, we get a new option here where we can use alternative income. So full doc is what we use for conventional and FHA. So typically we'll choose a non-QM option to use an alternate, such as asset related, business bank statement, our investor DSCRs, only for investment properties. We'll talk about that shortly. Our personal bank statement 12 month is the most popular. We always use that for the demo. And we have RSU, stated, VOE, 1099 P&L, no income CDFI, all kinds of different options. But we do the 12-month personal bank statement as our most popular option for our self-employed borrowers. Many times it's our self-employed borrowers, when they submit 2 years of tax returns, have various write-offs and may not qualify, or just may not quite get enough income to get the home they really want. So we solve that problem with our bank statement program. We don't use any tax returns involved at all, only their last 12 bank statements to determine a debt to income ratio of 40% using cash in the bank statements rather than tax returns. Most of our self-employed borrowers will qualify for double or triple the income using this method and therefore can get the home they really want. So let's check out the non-QM solutions today. And about the same as it was yesterday as well. 7.5 rate, 2.125 discount points and cost. So non-QM does have a little bit higher cost. And the final APR 7.604. So just a touch higher, about 0.3, 0.4 higher here for a bank statement option, which is amazing, almost identical to conventional here. And you see we have dozens, if not hundreds of different options here using bank statement income. But some of these options at a little bit higher rates or costs may allow things like bankruptcies and foreclosures and other items that would cause us to otherwise not qualify. So these are great options. Please get with our team to find the best one that fits your scenario. Now, before we go into portfolio loans, we're just going to do some live pricing for investment properties as we do every morning. So we love to work with investors, first-time investors, seasoned investors. We have a ton of options. So we'll set up the same scenario, 80% loan to value, 20% down payment. And we'll compare our investment property options, our conforming conventional options, with our expanded guidelines, aka non-QM. Remember the government programs, FHA, VA, USDA, they don't work for investment properties. So we'll start with conventional conforming. Everything will stay exactly the same. The only thing we've changed here is investment property. So we can see the adjustments the conventional programs have here for investments. So the best rate here, 7.625, 3.375 discount points and costs for a final APR of 7.871. So this is a good option for our customers that want to qualify for a conventional loan. However, most investors would like other options. Typically, investors don't mind a higher rate to reduce the cost. 3.375 discount points and cost is $13,500 in our example here. Most investors would rather spend that elsewhere. So they would like other options. Unfortunately, conventional doesn't really have any other options. So that's where we love to present our non-QM. So we'll do our final demo here for live pricing, investment property, 80 LTV, 20% down payment. And this time we'll choose expanded guidelines non-QM. So first thing we need to select is our income option. Most popular for investment properties, going to be our DSCR option because it doesn't require any income or employment from our borrower. Simply use the estimated rental income to determine a DSCR value. If that stands for debt service coverage ratio. If the debt service coverage ratio is over 1.00, that means the property cash flows on a monthly basis and the estimated rents can cover the PITIA of the mortgage. We have options for under 1 ratio as well. And for our demo, we always use 1.5 as the highest value so we can see all the options pop up. And finally, a prepayment penalty is standard on a non-QM investment property. 3 years is standard. We can select 0. That will cost more and limit the loan programs. And we can also select 5 years, which will cost less, but also limit the loan programs. So we can see the most common options. We'll choose 3 years so we can see all the best options pop up. So let's check the DSCR rates today. All right, best option at the top here, 7.99 rate, 0.85 discount points and cost, final APR 8.052. So almost identical to conventional. I'd say 90+% of investors, when presented with a DSCR quote here that's within about 0.2 of conventional, are always going to choose a DSCR quote for the ease. You can also do 1, 2, 5, 10 of these loans at a time, cash out multiple properties, purchase multiple properties, tons of flexibility. And you see we have dozens of different versions here. Some of these may allow bankruptcies, foreclosures, other credit events. Some of these may allow us to use short-term rental income. And some of these may allow other exceptions, obviously not at the programs we can quote instantly, but we do have options to combine multiple properties. So let me switch my screen and we'll get into that topic for today. So a portfolio loan. This is a loan where we're going to combine multiple properties into one loan. There are various reasons why we would do this, and there are definitely numerous reasons why we would not want to do this. So first, Jose, before we go into any actual demos, let's talk a little bit about why and what we're doing here. And then we can go into the actual demos there, because I want everybody to understand it sounds like a good idea, but it's not often the solution that we're looking for or our borrowers are looking for. Remember, the portfolio loans are, as Jose will present here in a minute, typically going to have a lot more restrictions, more costs, more fees, and we can typically get a better deal for our customers if we can do the properties one by one. But if there is a specific reason where we need to combine properties, which sometimes there is, this is the proper solution for that reason. So, Jose, if you're ready, let's have you go ahead and talk a little bit more about it, and then we'll get into the actual examples.
All right. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you here this morning. Portfolio loans are also known as blanket loans. Actually, a blanket loan is the technical name for it. We just tend to call it portfolio loans because it's borrowers that have a portfolio of properties that are the ones that get this product. Now, again, portfolio is a word that has multiple meanings, right? A portfolio could be a portfolio loan, which is a loan that a lender does that where they keep the loan. They don't sell the loan. So it's a portfolio. It stays in their portfolio and they create their own guidelines. We have some portfolio type loans for investment properties where we're talking about a single property, not a portfolio. But in this case, when we're talking about portfolio loans, we're talking about for the investor that has multiple individual folioed properties. So each property is an individual property, their own property tax ID number, right? We're not talking about a multi-unit building with 10, 20, 30, 40 units. We're talking about an investor that may own 10, 20, 30, or 40 individually titled properties. So that's the first thing to note here when we are talking about a portfolio or a blanket loan. Now, there are a few misconceptions about portfolio loans and why an investor would want to finance their portfolio of properties with a blanket loan, right? They tend to believe that there will be some type of savings in the process, right? Maybe some type of savings in the title insurance, maybe some type of savings in the underwriting fees, different lender fees that they may incur, different title fees that they may incur. And that's just not totally true. these properties all need their individual titles, right? There are individual properties, they're just under one blanket loan, but they all have individual titles. So you're going to need individual title insurance for all of them. The title companies, when these transactions are complicated like this, may also want to charge a higher closing fee. And also, the lenders tend to have different funding fees and property review fees. So, in the end, the fees more or less even themselves out. The savings, if there are any, may be nominal, $500 or $1,000 or something like that, just in some kind of a administrative fee that you may save. But the transaction related fees like the appraisals, you're going to need an appraisal for each property. You're going to need title work for each property. So there really is not going to be any savings in that respect. And then we run into the issue of having less flexibility with your property in what you can do with it, right? You may have 10 or 15 properties, let's say, in a portfolio, and you may want to sell one of those properties, or maybe it has more equity than one of the other properties. You may want to do a cash out refi in the future on just that one property, or two or three. Well, you have to be aware that portfolio loans will have restrictions on removing properties from the loan, right? I mean, you have a loan with, let's say, 15 properties, uh, it's set, right? If you take one property out, you throw the portfolio out of balance. So in some cases, they do not let you carve out any properties. That's what the phrase is for when you want to remove one property from the portfolio. You want to carve it out. So some portfolio options may let you do that. There will be a balancing fee. Let's say that property owes $100,000. They may have you pay down an extra 20% of that loan just to balance out the portfolio. And in some cases, most of the cases actually, they just may not let you carve out an individual property. It's basically going to be all or nothing. So you can see how that may affect your strategy if if you like to hold these properties for rent, but also as the opportunity arises, sell them, to get some money and maybe buy some more great deals that you're going to rehab, rent, hold for a little bit, and then sell, right? It's a very good strategy. But if all your properties are in a portfolio loan, that may not be an option. Now, that does not mean portfolio loans do not serve a purpose. They serve a lot of great purposes. The portfolio loan is the ideal loan for when an investor wants to buy low value properties. We know that those low value properties have a great rate of return. The DSCRs on those are very high, right? I mean, I did a portfolio loan in Milwaukee, Wisconsin on 7 properties where the DSCR on that loan was 2.0. So that's a very good deal. These were all properties between 90 or somewhere between 80 and $100,000, right? And as you know, in the investment property world, it's very difficult to finance properties under $100,000, and almost impossible to finance properties under $75,000 in loan amount. Now is what I'm talking about. 100,000 loan amount and $75,000 loan amount. So if you have a purchase of, let's say, $90,000 and you're trying to do 80% of that, you may be out of gas. Or $80,000 and you're trying to do 75%, it's going to be very difficult. But with a portfolio property, you can group together at least 2 of these properties. We're doing one right now. It's two properties. I think each loan is $60,000. So $120,000 loan, and the only way this borrower was going to be able to use financing for that deal other than hard money, that is. And hard money has its drawbacks because it's usually short term in nature and high in cost. So this borrower was able to finance this transaction with a portfolio loan, where normally it would have been, like I was saying, hard money or cash only. So in that case right there, it's going to be all or nothing for the purchase as well. So the investor was very happy to use the portfolio loan for his financing needs, because that's the only way he was going to be able to get it done. So keep that in mind when you do have your strategies. I had, by the way, that last portfolio deal that I was talking about in Milwaukee, Wisconsin, how it came about. The investor called me asking how low could we go in the loan amount. So I basically told them on on a DSCR, because by the way, the portfolio loans are DSCR loans, and the one that I'm going to be sharing with you shortly is a no ratio DSCR loan. So, you don't even have to worry about the rent, just the value, the title and the other factors like that. So in this case, this investor asked how low could we go. I told him 75,000, but then I asked him, what is your objective, and what is your, how much do you have available for down payment, closing costs? So when he mentioned how much he had available, he could qualify for up to $1 million purchase. So I then told him the strategy. Why didn't he go out and find 5 or 6 or 7 or 8 properties, and we could do a portfolio loan? And within 5 or 6 days, he had located the seller that had the properties, because that is another catch to the portfolio loan. They have to close. It has to close, all in one shot. You can't close it with individual sellers, right? You can only pay out in the closing to one entity. So it would have to be purchasing the properties from a seller in all in one shot, and then you're going to finance them all in one loan. So he was able to find a seller that had 7 properties. He put them under contract, and we financed it, and he was very happy with his 2.0 DSCR, and I think it ended up being like a 650, more or less $650,000 loan, when he had called initially asking about $75,000 loans, right? So you could see how you could really use the portfolio loans as an additional strategy to gain additional market share, and to help those investors that love those low valued properties, because the rents are very good on those. You're going to make very good cash flow on the low value properties. So let me share some of my quotes. I do have some purchase and some cash out refis. Now, with this particular option that I am sharing, the maximum loan to value is 75%, since they are a no ratio option, right? There's no DSCR that's going to be calculated, and they actually will go as low as, depending on how many properties you have, you can actually go as low as $50,000 per property on these. So the loan allocation per property, 50,000 at a 75,000 at a 75% loan to value. So you're looking at right here 9.99, and this is a borrower pay product. So the points there are 2.75 points. But again, very good rate here. And with this particular option, you can go up to 10 units, 10 properties, should I say? I don't want
What
to
size loan is that there?
This loan is 1.5 million. 1.5 million, $2 million purchase. Right. Oh, and something else I wanted to note, it gets even better. Minimum credit score of 650. Now, this example, obviously, I'm showing here is not the 650 credit score example. I'm at the top tier here on the credit, so I'm going to get the top tier rate. But again, they will go 75% LTV. Very important to note, right? 75% LTV, no ratio DSCR, with as low as a 650. And I will also state that we routinely get exceptions below 650. So don't be discouraged. I mean, we've done them at 640, 642, stuff like that, and that's amazing for a 75% LTV, no ratio DSCR, and much less when you're talking about a portfolio. Now, this example here, I showed where we can reduce a little bit of that cost by bumping up the rate a little bit. So you bump up the rate 0.5%, and you have 1 point lower cost to the borrower. So right here in this example, the 10.49 would be 1.75 points to the borrower, all in. In other words, that's their fee. There's no additional fee. There's no additional buy down, no additional anything. It's 10.49 and 1.75 points. And now let's do our cash out. Oh, didn't get my cash out right there, but I do have my cash out right here. This is the buy down option is the buy up option. The 1.75 point option is 10.99 at a 75% LTV again, and the other rate that didn't populate was 10.49 would be the 75% LTV option, 10.49 at the 2.75 points. And again, you will note 75% LTV on the cash out refi, 75% LTV on the purchase. So there really aren't too many options out there to do a 75% LTV, no ratio DSCR cash out refinance, and much less on a portfolio loan. So very good options here at the mortgage calculator for your portfolio loans.
All right, looks like we do have one question here. If you want to pull that up on the screen, Nick. Richard's asking, is there such a product for a blanket loan for fix and flip to help those investors out where the prepayment and rehab cost is less than 100K?
Well, no, there's not.
Purchase price, I guess I should say.
But the fix flip lenders out there will go to low dollar amounts. I mean, what they're really more interested in is what's the as is value, what's the rehab budget, what's the ARV, what's the profit, right? If it's a good deal, they'll do it under $100,000. They don't have like a cap that they don't do loans below $100,000 for fixed flip. So definitely, there's plenty of options out there for lower loan amount fixed flips, but none of those will be a portfolio loan because remember, the portfolio loan is a long-term 30-year loan, whereas the fixed flip loan is a bridge loan. It's a short-term loan.
Based on one property, right?
Yes.
They're looking at everything on one property. It wouldn't really work if there were multiple properties in there. Each one has different ARVs and different, right? So
it would be a nightmare.
Right, absolutely. All right, I don't see any other questions. Great training there, Jose. I love your example that you did because it's just amazing that you took somebody. Here's another example of why loan officers shouldn't brush anybody off. Oh, it's not worth my time to do this little deal. This client's just asking for the lowest possible loan amount. And Jose took a gentleman for lowest possible loan amount and times it by 7 consulting with his client, making him understand the options that there are. And now this gentleman owns 7 houses that he wouldn't have owned, and Jose got a nice size deal. And I'm sure that client's going to come back when he's looking to purchase more properties or refi them all out of that loan, or whatever the case may be.
Yeah, that'll be usually what they do. It's sort of a cycle. They get the portfolio to get them, and then when they increase in value, I wouldn't say they get greedy, but they just get ambitious to buy some more properties. And obviously the best way to do it is to tap into your gold mine that you already have, get that equity and buy some more.
Absolutely. All right. Well, if you need more info on these programs, visit us at themortgagecalculator.com. Remember, we do this show every weekday, 11 a.m. Eastern, where we go through the live mortgage rates and then do a deep dive into a different topic. So we will be right back here Monday for a different topic. So thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. We'll see you all Monday, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great weekend, everyone.
Thanks, everybody.
Thank you, everybody.